Introduction to Banking and Financial Institutions. The term bank, in a general sense, refers to any type of financial institution where you may deposit money. Consumers look to banks as secure places to save money, obtain credit, and withdraw cash. When you deposit money in a bank, it doesn't just sit there. Your money is lent to borrowers who need cash for business or personal financial needs. However, you can access your money on demand. When the bank loans some of your money to other people, those borrowers pay interest to the bank. Interest is a fee paid for the opportunity to use someone else's money over a period of time. If you have a savings account, the bank pays you interest for letting it use your money. Because the interest paid by borrowers is generally greater than the interest paid to savers, banks can make a profit from these transactions. In addition to providing savings accounts and loans, banks fulfill other functions and offer other additional services. There are a few different types of financial institutions. Commercial banks are financial institutions owned by shareholders and operated for their profit. Credit union is a non-profit financial institution owned by its members. The members have a common bond, such as working for a certain employer, belonging to a labor union, or living in a certain region. Savings and loans are financial institutions that originally specialized in providing funds to home buyers, but now provide a variety of financial services. Although some are owned by shareholders and operated for profit, many are owned by their depositors. Other types of savings associations, such as federal savings banks, are similar to savings and loans. Mutual savings banks are state-chartered financial institutions operated by trustees for the benefit of depositors. Profits are either paid to depositors as interest or held in reserve. Some financial institutions operate exclusively over the internet using online banking. Since internet-only banks do not maintain branch offices or employ tellers, they operate efficiently and can pass along their savings to customers. Thus, they may offer higher deposit rates and lower loan rates than traditional brick-and-mortar banks. Now let's look at things to consider when choosing a bank. As far as rates and fees, you want to compare interest rates, fees, and special account requirements. You can get this information from a bank employee or on a bank's website. Keep in mind that some financial institutions offer better terms if you maintain a certain balance or combination of accounts. As far as services, you want to make sure that your bank is convenient for you. You want to find out what services are offered by the banks you're considering. Choosing one bank that offers all the services you will use may be preferable to dealing with different banks for different needs. Does the bank operate branch offices near you with convenient hours? If not, can you conduct your transactions another way, such as over the phone or over the internet? You also want to consider deposit insurance. In the event of bank failure, deposit insurance protects you from losing the money in your accounts. The FDIC, or Federal Deposit Insurance Corporation, is a federal agency that insures savings, checking, and other deposit accounts in most commercial banks, and savings associations. If the financial institution goes out of business, the FDIC will reimburse losses in insured accounts up to a maximum amount per depositor. For credit unions, similar deposit insurance is administered by the National Credit Union Administration. Both FDIC and NCUA insurance are backed by the full faith and credit of the U.S. government, making deposit accounts safe and secure.